Hello everyone. Today we are going to discuss Professor Damodaran's take on how merger and acquisition affect valuation and what drives those changes. Well, let's start with synergy. Synergy is of two types: operational synergy and financial synergy. Operational synergy can be achieved by combining the firms to attain either a competitive advantage or or a economies of scale. Now, strategic advantage or competitive advantage can be achieved through new and high investment opportunities, boosting return on capital, growth, and sustaining excess returns. Economies of scale can help us to reduce the cost as well as increase the base year EBIT. Now, coming to the financial synergy, it can have three effects. First is increased debt capacity, that is, it reduces the cost of capital by combining both the firms. Then there is tax benefits if one of the firm is highly depreciable or it has so much carry forward losses that the tax laws of that nation or that place can be used to reduce the tax and increase the tax benefits. And last but not the least is the availability of capital that reduces the that is diversification of two firms. Diversification reduces the cost of equity, especially for the private firms. Now, Damodaran highlights that the synergy cannot just be said verbally. It should show in numbers like increased revenue, boosting margins, or higher growth. Thus, while calculating synergy, we need to have a synergy value. How do we calculate it? Well, the formula is fairly simple. It is the value of combined firm with the synergy minus the value of combined firms without the synergy. Thus, once we get the synergy value, Professor Damodaran highlights that the excess that we pay for the acquisition should never exceed the best case synergy value. Then Professor Damodaran highlights the value of control. Value of control simply says that if the firm is poorly run, then once you acquire it, it is better to take control of the management and increase operational efficiency. That would increase the profit and give us a value for taking the control of the farm. Contrarily, if the farm is already well run, then there is no need to take control of it. Thus, there is a very little or less value of control associated with such case. Lastly, Professor Damodaran has highlighted that owing to the current market trends, mostly the complex firms are undervalued while the simpler firms are overvalued. That is a problem. Hence, Professor Damodaran strongly suggests to use a framework, that is complexity score framework, which uses techniques and metrics to evaluate a firm's transparency and complexity. Professor Damodaran highlights that using complexity score framework would give us a better valuation rather than just relying on the market trends. Thus, we learned a lot about how Professor Damodaran has helped us to properly value merger and acquisition of firms. So, thank you so much and see you in our next video.